Our first learning objective: interpret interest rates as required rates of return, discount rates, or opportunity costs. And by the way, all three of these are just different ways of thinking of the same thing. We'll introduce an interest rate and we can see it as different things. And explain an interest rate as the sum of a real risk-free rate and premiums that compensate investors for bearing distinct types of risks. And when we say real risk-free rate, we typically mean default risk-free. Okay, interest rates can be thought of in three ways: as a required rate of return, as a discount rate, and as an opportunity cost. And we'll see that it's pretty much, you're looking at the same rate. It just depends on how you're using it. For required rate of return, we think of it more in terms of determining the future value of some present value. So I say there's this investment, it'll cost $100. You may say, well, given the risk profile and how long I have to tie up my money, I need 8%. If I'm going to do it. Well, then that's the required rate of return. That's the return that you require to invest in that security. When we talk about a discount rate, here we're determining the present value of some future value. So you may say, I have this goal of making a deposit on a house in 3 years. I'm going to need $40,000. If I invest in a basket of securities, how much do I have to invest today such that I have $40,000 in the future? Well, we would discount that $40,000 by whatever the expected return on that portfolio is, and we would arrive at a present value. And for opportunity cost, it is how much you would give up by not investing in a particular security. So you say, well, I'm going to spend $1,000 today. And if the interest rate is 5%, a 1-year interest rate on a security that you can get is 5%, you're giving up $50 of income over the course of the year to spend that $1,000 today. That is the opportunity cost of spending your money today. It is the value that is foregone. And you think about an interest rate when you're making a decision between current consumption versus savings. The higher the interest rate, the more you will lean towards savings because you will think, but the opportunity cost is too great. If interest rates were 20% and you say, I'm going to spend $1,000 today, well, you could have $1,200 in a year. By spending that $1,000 today, you're giving up the opportunity, right? The opportunity to make $200. That's why we think of it as an opportunity cost. So it's not that they're different interest rates. It could be the same 8% all the way. Hey, look, I need 8% to invest in this security. That's my required rate of return. If I want $40,000 in 3 years and I can invest at 8%, how much do I need today? Well, now I'm using that interest rate as a discount rate. If I'm deciding whether I want to spend money today or wait a year, I think, well, I could make 8% on my money. Well, then I'm thinking about it as an opportunity cost. Let's look at the determinants of interest rates. The first component is some real default risk-free rate. Because if we buy government securities, let's say a TIPS, this is a Treasury inflation-protected security, we will get a real coupon, and the principal will adjust for inflation. So if we can get that, and that's default risk-free, then everything else must pay at least more than that, because in the absence of anything else, we can get that. So the real default risk-free rate. Now, when we say risk-free, notice I put the word default in here. The learning objective didn't have the word default. A real rate is not entirely risk-free. It is default risk-free. There is some risk in terms of reinvestment risk. There's inflation risk when we get to the inflation premium. So it's not that it's completely risk-free in the sense that there's no risk. There's just no default risk. We call it a single period rate. Single period could mean anything. It could mean 1 month, 3 months, 1 year, 4 years. It could be a period of 3 years, so that you get some cash flow at the end of 3 years, and there is one rate at which we would discount this future cash flow to determine what the present value of it is today. These are called spot rates. You will see this in fixed income. The difference between par, spot, and forward rates will be introduced in fixed income. To that, we can add an inflation premium. This is the expected inflation over this period of time. So if we have the real rate, a 3-year, which is a single period, the period just happens to be 3 years. If we have a single rate, we can add on an inflation expectation. Notice that's pi to the power of e. Whenever you see this terminology, that means inflation expectation. Well, a real rate plus an inflation expectation, what is that? That is a nominal rate. So whenever you go to the bank and it says we pay 5% on 3-year CDs, that 5% is a nominal rate. It includes both a risk-free rate and an expected inflation component. Next, we add default risk premium because this really is the purview of government debt. Once we get into corporate debt, well, corporations can default. In fact, once you get into municipal debt, muni bonds have default risk in them as well. So if there is the possibility of default, well, I got to be paid a little bit more for that. If I'm going to get 5% for something that can't default, and you want me to be in something that can default, no matter how small the probability exists, I got to be paid for it. So it compensates for credit risk. And there are two broad types of credit bonds. There's what's called investment grade and high yield. Once you get into high yield, they rarely trade. They become very, very illiquid. So, well, it stands to reason I need some kind of premium for the fact that once I buy one of these bonds, it's probably going to be very hard for me to sell it after because they rarely ever trade. So liquidity premium, this is the risk of loss versus fair value if an investment needs to be converted to cash quickly. When you have a liquid market with nice tight bid-ask spreads and you need to sell something, you can sell it pretty much at whatever the market price happens to be. But the more illiquid something is, it's going to be hard to get fair value for it because there's just nobody in the market buying and selling. So you have to try to find a buyer, and the buyer may not be willing to pay fair value, saying, well, I really wasn't going to buy it, but if I'm going to buy it, you got to give me a deal here. And then there's a maturity premium. If I lend you money for 1 day, it is not as risky as if I lend you money for 2 years, because over 2 years, all sorts of things can happen to you. But over the next day, your credit risk isn't going to change that much. But over 2 years, it can change quite a bit. So there's a maturity premium. Compensation for greater price sensitivity for changes in rates. Also a compensation for the greater credit risk whenever we look at credit curves, even though it's not really written down in the reading. If we look at credit curves, and let's say we're looking at investment grade debt and we're just looking at the credit spread, never mind the interest rate, we've just isolated the default risk premium. You will find that it is upward sloping. The longer you lend money for, the greater the credit risk. What is this saying here? Compensation for greater price sensitivity from changes in rates. You will learn in fixed income that the longer the maturity of the bond, the more sensitive it is to changes in interest rates. In other words, the greater the price change, it will be for a change in interest rates. So if interest rates go up, bond prices go down. There's that inverse relationship. The greater the maturity of the bond, the more sensitive it is to the same change in rates. So you'd want some kind of maturity premium for that. If you were just dealing with government bonds, the maturity premium is correctly stated this way. If you're dealing with credit risky bonds, the maturity premium is a combination of the greater price sensitivity plus greater price or greater credit risk as time continues on. All the fun stuff that you're going to see in fixed income. So I mentioned the nominal risk-free rate, and again, let's make sure that we understand that we're talking about default risk-free here. And I said it is the combination of the real default risk-free rate and an inflation expectation. You can add them together to get the nominal interest rate, or you can multiply them. They're both acceptable ways to getting to the same rate. Multiplying them or adding them will give you a slight difference between them. But if you ever get to a question, let's say in a question bank or on the exam, where it's open to interpretation. Do I add them or do I multiply them? It will be clear. CFAI will state they should be multiplied, or they could be, they could be added. If you're multiplying them, it's 1 plus the default risk-free rate multiplied by 1 plus the inflation expectation, and that will give you 1 plus the interest rate. Another way of writing it is, I'll just do this on the fly. You can take this off of here, and if you put square brackets here and subtract 1, you can isolate the interest rate. The reason you add 1 is because you cannot multiply 0.04 times 0.02. All you'll end up with is some 0.0008, which is 0.08%. So you can't multiply 4% and 2%, a 4% risk-free rate and a 2% inflation rate and end up with 0.08%. You must add the ones in front of it. And then after you multiply, you can subtract the 1 out to isolate R. I should note here, early in the process, hopefully you're beginning with Quant and the first reading, obviously. This will save you a lot of grief later on. All rates are quoted on an annual basis. So if you see a 3-month T-bill rate quoted at 4.2%, that is not 4.2% for 3 months. That is an annual rate, 4.2%. But you're only going to hold it over a 3-month period. But annualized, it's 4.2%. All rates are quoted on an annual basis. So, for example, 3-month T-bill at 4% is 1% over 3 months, right? Because 3 months happens 4 times a year. That's a quarter. So if you just do a naive interpretation, you just divide it like this simply, you'll see that it's 1% over 3 months. It's not 4% for the 3 months. That ends our first learning objective. At this point, I'm going to direct you to the reading and to do the reading examples. And they are in text box like this, and it'll say example 1. When it comes to numerical examples, when it comes to math, it is critically important that you actually go through the process yourself. You cannot memorize math. You can memorize formulas, but you can't memorize process. Process is muscle memory. You really have to work a problem and a number of problems till it becomes ingrained in your mind how the process works, what the steps are, so that you actually see it. So that's why when it comes to the numerical examples, I'm going to leave quite a bit of them to you because that is absolutely critical to forming your knowledge. Next, learning objective, calculate and interpret different approaches to return measurement over time and describe their appropriate uses. Let me draw your attention to something that I want you to start paying attention to. Look at the keywords. We have a calculate. Let me get a better pen here. Calculate and interpret. CFAI sticks very closely to the keywords in the learning objective, which means if they were going to test you on this particular learning objective, it will involve some form of calculating or some form of interpreting. If you come to a section which has formulas, and there is no calculate or interpret, but only a describe, then you really just have to understand the relationship of the variables, that if the numerator increased, what effect would it have on the outcome? If the denominator increased or decreased, what effect would it have? But here, we have a calculate and interpret. Whenever you see calculate, whatever formulas you come across, you should be writing down on your formula sheet. Okay, we'll be introducing some formulas here, but honestly, this is all stuff you've seen in high school. There is nothing challenging to the arithmetic here. Let's do the holding period return, and that's all it is just a holding period. We're making no distinction about how long that holding period happens to be. It could be 2 weeks, it could be 3 years. Later on, we'll learn how to annualize any number that we have. So if we have a 3-month return, if our holding period was 3 months, we have a 3-month return. How would we state that on an annual basis? Because go back to the previous screen, all rates are quoted annually. So we want to make sure that we quote them annually. Holding period return, it looks like this, PT minus P naught. PT is your ending price, P naught is your beginning price. So if you're taking your ending price minus your beginning price, that's just the change in value of the security. Add all the income that you received, the top, the numerator, is your return divided by the original price to get a rate of return. This is your dollar return here. This is the invested capital. Divide the two, you'll get a rate of return. So let's say that you bought something for $100, it went to $105 and paid no income. Well, that's how simple it is. So if you're looking at that going, oh, it can't be that simple, it is. It's just that you must learn the language. So if somebody says the holding period return was 8%, you go, wow, the arithmetic behind that is easy. It's just maybe I'm confused about what a holding period return is. And somebody says my holding period return was 8%. The next logical question would be, yeah, well, how long did you hold it for? If it was 10 years, that's pretty pathetic. If it was 2 weeks, hey, not bad. What are you doing? A multi-period holding return. Let's say that you have a number of different periods. Let's say you have a 6-month period, a 12-month period, and another 6-month period, and you calculate holding period returns for all three. You can just chain, multiply them, subtract one, you'll get your rate of return. That rate of return will be a 2-year rate of return, not an annualized rate. Now, it's still not annualized. That is for 2 years. Again, later on, I'll show you how to annualize that. This one, you've seen this one. This is just calculating an average, right? Arithmetic or mean return. You add up all your returns and multiply by 1/t. If this looks confusing, another way to see it, and I'll just do a quick edit on the fly here, is you add up all your numbers and you divide by t. T being the number of observations you have. Well, you know how to do an average. If you have 4 numbers, you add them up and divide by 4. That's all this is. That's all it is, except we're just adding rates of return. A geometric mean return is, we've seen this in the holding period return up here, is you just chain multiply a bunch of returns, take the root 1/t, or if t is 5 years, that's just saying take the 5th root. Taking the 5th root is the same as putting it to the power of 1/5. So let's say that we have a return series that looks like this. In year 1, we made this, year 2, this, year 3, this, year 4, that, year 5, this. Well, we can calculate an average return per year. But what is more interesting sometimes is saying, well, if I draw a straight line from the beginning to the end, and we know we have 5 years in here, what was the constant return per year that brought the beginning value to the ending value? That is called a geometric mean return. So for example, let's say in year 1, we lost 50% of our money. In year 2, we made 35%. In year 3, we earned 27%. Over a 3-year period, what was my annual rate of return? It's 1 plus, since this is a negative 50%, it's 1 minus 0.5, so 0.5, 1.35, 1.27, multiply them out and take the 3rd root, which is the same as to the power of 1/3, subtract out the 1, because of course you added the 1 in, negative 5%. In other words, you lost your money at a rate of 5% per year for 3 years. If you took an average of these, you'd get a different number. The arithmetic mean and the geometric mean will be equal when every return is identical. As soon as you introduce variability into the returns, the arithmetic mean will be higher, always higher than the geometric mean. So what is the geometric mean measuring? It is measuring the growth rate or the compounded return of an investment. So if we look at a particular fund and it says $1 in, or sometimes you'll see this, $100 invested 5 years ago would now be $137. So you can calculate what the geometric mean return is per year, which is the constant amount that you've earned per year over that period of time. If the ending value was $137, the beginning value was $100, and it was over 5 years, you put it to the power of 1/5 minus 1, and you will get the constant rate of return per year that it earned. Okay, more formally, what I said on the previous screen about the relationship between the geometric mean and the arithmetic mean, here it is here. The geometric mean will always be less than or equal to the arithmetic mean, unless all observations are equal. If that is the case, then the geometric mean will equal the arithmetic mean. Under no condition will the geometric mean be greater than the arithmetic mean. And because we live in a random world, a complex financial system, it would be extremely rare to have the return every single period being identical, which means there's going to be variability in a return series. In all return series, there is variability. So it will be very common, in fact, if not the norm, to see the geometric mean less than the arithmetic mean. Well, when do we use these? If we're trying to describe the growth rate of a dollar in a particular investment, how it's going to grow over the next 5 years or how it's grown over the past 10 years, we would use a geometric mean. It is used to estimate the expected return over multiple periods. And it has this relationship between present value and future value. If we take the present value and we grow it at the geometric mean for whatever number of years, we will equal the future value. The arithmetic mean is just the average return over time. So if we wanted a one-period estimate, what is your best guess as to what the market will return next year? You would say, well, it would be the average of all, take the last 80 years of returns, take the average and say it'd probably be the average if you're looking for a one-period return, right? It is not true that if you take the present value over a number of years and you compound it at the arithmetic mean that you will equal the future value. That is not true. It is true of the geometric mean. It is not true of the arithmetic mean. So the takeaway here, what you should keep in mind is if you're looking for an expected return over a number of periods, use a geometric mean return. So you'd look over the past 80 years and you'd calculate a geometric mean return and you would say, over the next 5 years, we expect that. Whereas if you're looking for a 1 year return, just one period, you would say, well, what is the average return that we've gotten over the past? Let's move on to the harmonic mean. This you may not have seen before. So let's get to the formula. The formula may look confusing. It's n over the sum of 1 over x, x being the observations. Remember when we take an average, you'll take the sum of all the x's and you'll divide it by n, right? Well, invert the numerator, the sum of all the 1 over x over n. Now invert the whole thing, n over the sum of 1 over x. So if you forget the formula for the harmonic mean, just start with the formula here and invert the numerator, then invert the whole thing. So you invert twice and you'll get to the harmonic mean. Well, what is this trying to do? An arithmetic mean, all observations have the same weight. Notice that we're just summing over here. You're summing all the observations, dividing by n. So let's say that you had 10 people in a room plus Warren Buffett, and you calculated the average wealth per person in the room. Well, it's going to be huge. Everybody in that room, on average, is going to be a billionaire because Warren Buffett has so much money. But that's simply not true of anybody in that room, right, other than Warren Buffett. So it is sensitive to outliers. Well, what if you want to get rid of the outliers? You want to underweight that observation. Well, that is what the harmonic mean does. Observation's weight is inversely proportional to its magnitude. Therefore, it reduces the effect of outliers. Most commonly used with ratios. Ratios meaning the amount of something per unit. So let's look at PEs. Let's say you observe 3 companies. One has a PE of 45, and then you have 15 and 15. So a good example of this would be looking at North American automakers, and you have Tesla, Ford, and GM, and you're looking at the average PE in the industry. Well, Tesla's PE is super high. GM and Ford are like 7 or 8. Tesla's in the 40s. So it would be unrealistic to calculate an industry average in that sense. So you think, well, there's got to be some average. There's where you would take the harmonic mean and probably come up with a more realistic average. If we took an arithmetic average of these 3 numbers, we'd have an average PE in the industry of 25. Let's do the harmonic mean. And all we're doing is we're inverting. So it's the sum of 1 over x. So it's the sum of 1 over 45 plus 1 over 15 plus 1 over 15. You're just adding the 3 up, and that is your denominator. The numerator is n, which is 3. You get 19.28. Closer to the 15s. What it does is it gives less weight to the 45 because it says, well, it's an outlier. However, it does exist. it's there, it has some validity, but if we use it as a part of the average, it's going to skew what the let's say more realistic average would be. 19.28 given these PEs seems to be more realistic. It underweights the 45 as opposed to using the 25. Much like the case of Warren Buffett in a room with 10 people, everyone is suddenly a billionaire, right? Which we know is unrealistic and cannot be true. Okay, let's do another application of the harmonic mean here. If you've ever done any dollar cost averaging, which is very common in defined contribution pension plans. So what that means is every paycheck you'll have like $200 that goes into your pension plan, and you may be buying $200 of a mutual fund every single month. But the price of the mutual fund differs every month. So you have a constant amount of money, $200 a month, but you're buying a varying number of shares. So if I say, well, what is your average price per share? You can calculate it the long way by figuring out, well, how much should I pay per share each of those 12 times? Or you could do it in one step with a harmonic mean. So let's have a look at this. Let's say $1,000 a month for 2 months. We don't have to do 12 months and all the arithmetic to make our point. Let's just do 2 months. So $1,000 a month you're going to invest for 2 months straight in a stock. The first month you're going to be buying it at $10 a share. The second month you're going to be buying it at $15 a share. And if I say, what is your average price? A naive person would say, well, I paid $12.50 per share. It's the difference between the two. Not really. Let's just look at doing it the long way. You spent $1,000 at $10 a share. The first month you bought 100 shares. The next month you paid $15 a share. You bought 16.67, and we will go with the assumption that you can buy partial shares because some brokers do now allow you to buy partial shares. So you spent $2,000 on 166.67 shares. Your average cost is $12 a share, not $12.50. Interesting, right? Let's use the harmonic mean for this. So our numerator is n, which is 2. Our denominator is the inverse of the prices, 1 over 10 plus 1 over 15. It's 2 over 0.16 repeated. You get $12 per share. And I say proof. This is doing it the long way, just so that you can feel comfortable. Sometimes when we use a formula that doesn't look intuitive, we think, are you sure? Are you sure that's the right thing? So it's always nice to provide the proof to say, look, it is. Once we see that it is, we can then simply just trust the formula. Even if in our heads we can't intuitively see why, we've done the background work, we've done the proof, we said, okay, it comes to the same thing. Now there is a relationship between the arithmetic mean and the harmonic mean with the geometric mean. To understand this formula, let me first multiply 5 times 5. What are you going to get? You're going to get 25. Well, what is the square root of 25? It is 5. This is really you can write this as the same as, you can write this the same as 5 squared, right? The square root of 25 is 5 squared. Okay. Remember, the arithmetic mean overweights outliers. The harmonic mean underweights outliers. So let's say that the arithmetic mean overweights an outlier and you get 5.4 instead of 5. The harmonic mean would underweight it and you would get something around 4.6 instead of 5. You multiply this out, you'll get 25. Which, if you look at the geometric mean of 5% and you squared that, you'd get 25. So that's why it is squared over here, because you're multiplying 2. You'd have to take the square root of this to get to what R actually is. That is not a proof, by the way. That is just a way for you to see it in your head that, well, if this overweights the outliers and this underestimates the outliers, if you multiply the two, it would equal the geometric mean, but in a squared way because you're multiplying two numbers, right? We'll leave it at that. This is presented in the reading, this relationship. It is not a testable concept. I sincerely doubt you'll be asked any questions on this. It is just for your benefit. But I think you can intuitively see that if one overestimates and the other underestimates I think you get it there, right? Let's look at some other means. We have a trimmed mean and a Windsorized mean. The trimmed mean is very common in economic data, especially when you get to CPI. The reason is in CPI takes a whole bunch of goods and services and looks at the price month over month. Well, some of these prices do this. They move a lot. Some of them move a lot. So from month to month, you're going to have extreme movements on both sides where some prices have really gone up and then other prices have really gone down. Well, they're going to skew the numbers, so we calculate a trimmed mean, which gets at the more stable core group of prices. It removes a percentage from both the largest and the smallest. So let's say that we had 100 observations and we're going to calculate an 8% trimmed mean. That means 8% from both sides. We take the 8 highest observations and the 8 lowest observations and get rid of them, which means we're looking at 84 observations at that point. That is not a 16% trimmed mean, that is an 8% trimmed mean because we're trimming 8% from both sides, the 8 highest and the 8 lowest. Don't get confused between that. These number of observations is 16% lower than 100, but because we've taken equal amounts from both ends, we've taken 8% from both ends, totaling 16%. And then we simply just eliminate the 8 highest and the 8 lowest and calculate a trimmed mean. A Windsorized mean will do the same thing, but it'll say, whoa, whoa, whoa. With these 8 highest, make them all equal to the 9th highest. With these 8 lowest, make them all equal to the 9th lowest. So it doesn't get rid of them, it just changes the value of them to all be equal to the next highest one. So this would be the 94th observation, the 92nd observation, and then 93 to 100 would all be replaced with that particular observation. So we're replacing values at both ends with the cutoff value. So again, our 100 observations 1 to 8 are replaced, all of them are replaced and equal to observation 9. Observations 93 to 100 are all replaced with whatever the value of observation 92 is. So in the end, we have 100 observations. So we don't have 84 observations, we have 100, and we haven't just eliminated these and reduced our sample. We've left our sample the same, we've just replaced, not eliminated. We've replaced all with the same value, which does the same thing. Removes outliers on both sides. When you look at CPI, it is very common to have the trimmed mean CPI reported because CPI does contain some volatile components. And if we want to get an idea of the true trend in the underlying price level, sometimes getting rid of those extreme things helps a lot to figure out what is a more smooth change in prices. So at this point, there are some examples in the reading, as I've already explained, and I've explained what it means when you have math and arithmetic. You must walk your way through it yourself. That is really the only way to get that muscle memory. So at this point, pause the video and do those to reinforce what we've covered. Next learning objective, compare the money-weighted and time-weighted rates of return and evaluate the performance of portfolios based on these measures. Our keyword here is to compare. Time-weighted rate of return, we'll see, is nothing more than a geometric mean return. Our job there is done, right? A money-weighted rate of return, you will see later, is nothing more than an internal rate of return, or if you've been through the fixed income and you're familiar with yield to maturity, there's your money-weighted rate of return. Okay, beginning with our money-weighted return. Is also an internal rate of return, which means you can use Excel's IRR function. Values. I note this a little later on that if you have all your values in an array, you can use Excel's IRR function for that. In fixed income, it is referred to as a yield to maturity. It accounts for the timing and magnitude of investment. So here's an example. You buy a share of stock for $200, A year later, it's worth $2.25 and it pays a $5 dividend. And you decide that, well, okay, $2.25, let me buy another share. So now you own two shares. You bought one at 200. The next year you bought one at 225. A year later, they're both worth 235. So you sell them, you get 470, and you have two shares that paid $5 dividend. You get another $10 in dividends. Well, what was your return? That becomes a curious question. It's like, well, do you mean my average return, the growth rate of $1, or the money or the return that my money made? Now, you're committing money at different periods of time. Look at the first period of time here. What is our holding period return for the first period of time? Well, the stock went from 200 to 225. That is PT minus P naught plus the $5. So we got 30 over 200. We made 15% in our first period. We'll just call that one period. What about the next period of time? Well, we have two shares that are 225 now. Each of them are 225. We accounted for the first $25 over here, so we can't double count the 25. So they're 225. They grew to 235. We had two shares. They're up $10 a share. So we're up $20. Plus we got $10 in income. Over 450, because 225 times 2 is 450. We had 6.67% return in our second holding period. But notice what we did. We committed more money to at the beginning of a period that had a lower return. So the return on our money will be lower than some arithmetic return because we're committing more money at the worst returning period. If we just calculate an average return, 15 and 6.67 divided by 2, you get 10.84. If we calculate the internal rate of return, we can use Excel's function to get that done. If we're using our calculator, CF, our first cash flow, CF0 is negative 200 because it's an outflow. CF1 is negative 220. Why? Because we bought another share for 225, but we got $5 in. So our net outflow was 220. CF2, we had an inflow of 480. Don't forget the negative signs. We had an inflow of 480 because we got 470, or they're worth 470, so we assume even if we're holding it that it is a cash inflow. 470, we got 10, 480, compute IRR, you get 9.39. 9.39, less than the arithmetic average. Why? We committed more money to a poor performance year. That is why we call this a money-weighted rate of return, because we're weighting the return based on how many dollars we put in the investment. This is not comparable across investors or investments, that you could look at this particular pattern and 10 other people could have done the same thing as you, invest in this stock, but they could have committed money in different ways. Another person might have just bought 2 shares at this point of time. Well, their money weighted return would be different than yours. So you can't compare it across investors and investments. The money weighted rate of return, and I put MWRR. Over here we call it a money weighted return. You may see this referred to as MWR in a short form, or you may see it as MWRR. It really depends on the author that wrote the reading and the notation they like to use. MWR is money weighted return. MWRR is money weighted rate of return. It's the same thing. It just depends on what you like. I'm going to try to introduce you to as much of the variable notation as possible so that when you do see it, it's not a head scratcher going, well, does this mean something different? It's just a different author likes to use a different notation, that's all. So the money weighted rate of return represents what your money earned, not what a generic $1 could earn in that investment, but what your money earned because of the way that you committed money to the investment. The time weighted return. This is comparable across investments, and we've already seen it. It is a geometric mean return. It is the growth rate of $1 over a given time period. If we're going to compare mutual fund 1, 2, 3, 4, we want the time weighted rate of return. It is comparable across investments. So we say, well, if we committed $1 to each of these funds 4 years ago, how much would we have today? Without consideration for how we committed the money. Once we decide we want to be in investment 1, we may put $1,000 in here, maybe $5,000 here, take out $2,000 there, put another $3,000 in here. well, we're going to have a different return based on the weighting of the money that we had in. You can't use that as a comparison against other investors because, well, they might have committed money in a different way. Now, you can say, I earned this and you only earned that because I put money in at the right time. You didn't. Well, you can use it for bragging rights, but if you're looking at 4 different investments and you're determining which one you want to be in, you want to know the performance of the investment without that overlay of, well, hang on now, you got to put money in at just the right time and take money out at just the right time. No. What would $1 have grown by over 5 years? That's comparable. So how do we calculate this? We're going to break the investment period into holding periods. Thank God we already know how to calculate a holding period return, right? We break the investment period into holding periods, and each holding period will be demarcated by any significant cash inflows or outflows because we want to neutralize for those inflows or outflows. When you get to level 3 and you're going through the GIPS section, you will be required to calculate a time-weighted rate of return that accounts for cash flows that happen during the course of the period. And this is exactly how you do it. You break it into holding periods, you calculate the holding period return, calculate each one, you compound the holding period returns. Remember, we saw this on the previous screen. 1 plus holding period return 1 multiplied by 1 plus holding period return 2. And let's say that that's all there was, and that was, let's say this was 9 months and this was 15 months. Well, there's 24 months, that's 2 years. 1 over 2 will give it to you annualized. Calculate each HPR, compound the HPRs, then express it annually. So in keeping with the example that we had on the previous screen, let's calculate what the time-weighted rate of return is. This is the previous example from when we calculate the money-weighted rate of return. By the way, for time-weighted rate of return, you may see it written as TWR or as TWRR. So we calculated our holding period returns. Remember, that's the first thing we do. The first period was 15%. The second period was 6.67%. Then we multiply them together. We chain multiply them together, and then we annualize it. Since it was 2 years, the example was based on 2 years, we could take the square root, the second root, or just 1 over 2, subtract out the 1. There is the geometric rate of return, which means that if we had invested $1 in that stock, by the end of the second year, we would have realized an annualized rate of 10.75%. The arithmetic return was 10.84. Remember, the geometric mean return will be less than or equal to the arithmetic mean, and as soon as there's variability in the return series, it will be less. Well, there is variability, 15%, 6.66. It should be no surprise that we get a number less than the arithmetic mean. For very large funds, they have money coming in and going out every day. So what they'll do is they'll calculate a holding period return each and every day, and then they'll simply just chain them all together. Now, I put 365 in here because we have to account for the fact that, well, what if they have digital assets? Digital assets trade on the weekend. Bitcoin trades all weekend long, so if they have it in there, they can calculate a holding period return. Typically, if it's just restricted to publicly traded assets, this would be right around 252. The convention is to use 250 days because you can only have 250 days of returns. Subtract out the 1. This is for liquid underlyings with market prices. If you have illiquid holdings in there, you can't calculate daily returns. So let's say that you were a private equity fund holding a bunch of private companies. Well, from day to day, you don't know the change in price. You have to use a valuation model, and usually you're going to do a valuation maybe once a year or maybe quarterly. When you get to level 3 in GIPS, there are a bunch of rules about when you have to calculate your returns depending on the type of fund you are. So you have that fun stuff to look forward to. Let's make a happy person there. So this finishes that learning objective. I suggest you pause the video at this point and work through some of the examples in the reading so that you can reinforce the concepts that we just went through. Next, learning objective. Let's pay attention to our keywords here. We have a calculate and an interpret. So that means if you see formulas here, you should be aware of them. Calculate and interpret annualized return measures and continue